Welcome everyone to FX Streets. It's 8:04 a.m. Eastern. Today is Friday, October 26, 2012. Welcome back, one and all. Great that you could join us. I can hold off a few moments if there's more people going to join us. Well, I'll just start talking slowly. My name is Adam Rosen. Very happy that you could all be here today. 30 minutes from now, U.S. GDP, gross domestic product, will be released. This is a very big number. This obviously follows our Fed meeting yesterday, which more or less was a non-event as far as the Fed statement was concerned. But it'll be very interesting to see where U.S. GDP falls today. Taking a look at the charts, you should see, by the way, on both sides of the screen, on the left-hand side of the screen, we have this U.S. GDP chart. On the right-hand side, we have the Forex currency pair charts. Okay, and we'll focus on the dollar, Swissy, just because that's an easy way to demonstrate the dollar. Now, U.S. GDP, I believe the expectations are 1.6%. I'm sorry, 1.8%. What did I say, 1.6? U.S. GDP, actually, I'm sorry, FX Street's calendar has U.S. GDP annualized at 1.9%. And that's following last month's estimate of 1.3%. Now, U.S. GDP, let's go back to the chart here again. Last month was estimated 1.3%, which is certainly not a good number. We have an inflation target in the U.S. of right around 2%, and anything below 2% is not considered fast enough. That's inflation. That's what we're talking about, the CPI. But GDP, all the same, should be higher. There's a general correlation between U.S. GDP and the dollar Swissy, but there has been some disconnect. Let me say it this way. There's a massive disconnect between U.S. GDP and the Dow Jones Industrial Average. This is the chart we're looking at now. The blue line represents the Dow Jones Industrial Average. The violet line is GDP. In the old days, when U.S. GDP would move to the upside, we tend to see stocks would move up as well, and to the downside, conversely as well. What's happened over the past couple of years is there's been a massive disconnect. We can see that the blue line has continued to go up, up, up after that very big bottom in 2009. U.S. GDP recovered and then came a little bit down, not a little bit, very much to the downside. So the question is, why is there a disconnect? Why is the blue line so far separated, relatively speaking, from the violet line? The violet line is U.S. GDP on a quarter-over-quarter basis. The answer is quantitative easing. That quantitative easing has been somewhat of an artificial boost to stock prices that has not translated over to the GDP. And this chart really tells the whole story about the conundrum that we're in right now. That the Federal Reserve has embarked on massive, massive amounts of stimulus. QE1, QE2, QE3, Operation Twist, the first-time home buyer tax credit to spur on the housing market, cash for clunkers, that $787 billion stimulus plan, about 4 or 5 years ago at the beginning of the financial crisis. All of that has helped move stock prices up higher, but especially we're talking about quantitative easing, because quantitative easing involves the printing of new money, taking that new money, injecting into the economy. Sometimes we'll buy long-term treasury bonds. Sometimes we'll buy mortgage-backed securities or other treasury securities. And all of that capital ends up in the U.S. economy and helps to boost stock prices. There's more money in the economy. There's more money to buy iPhones and everything else. There's also more money out there in the economy in circulation to buy stocks, and that's why the stock market has gone up. But the problem is, why has GDP not gone up? I mean, after all, if the stock prices are going up, does that not mean that the economy is getting better? Should not GDP go up? And the answer is that the stock market sometimes can go up without the economy actually getting better. And that occurs under inflationary conditions. Now, the Federal Reserve, I think, would hope that the inflation would occur as a result of an improving economy. The economy starts to get better, more buyers and sellers, there's more demand out there, more people are shopping, more people have confidence to go shopping, and everybody working in the stores now starts making more money because there's more customers, and GDP starts to go up, and their salaries go up, and the economy improves. That's inflation as a result of an improving economy. That's not what we're saying, because otherwise GDP would be 2, 3, 4, 5%. I don't have it in the charts here, but if you go back to, it's really amazing, is go back to the charts in the 1980s. I want to make sure that everybody can hear me okay. Please let me know, if you don't mind, just let me know really quickly if you can hear me okay. The audio is okay. If you cannot hear me, please refresh your system. Okay, excellent. Thank you. Now, if you go back to the charts in the 1980s, after the financial crisis in the late 1970s, we had GDP that was up. I mean, I don't remember the exact number, but it was 5, 6, 7% GDP, because we're looking at it's kind of like the change. Not kind of, it is. It measures the change in the gross domestic product from one quarter to another. So, I mean, and if you take a look at the U.S. GDP after the bottom of the financial crisis in 2008 and 9, we actually hit levels of 5.6%. Comparing this financial crisis to the previous one, we initially had a big move up, but we're failing to sustain that rally on the GDP. 1.3%, that's not good. And just to give us a little bit of a basis of comparison, we'll go to, these are charts I've maintained for quite a long time here. I found it very helpful, though, to manually add in these figures. Take a look at the number that came in yesterday. This is UK GDP, quarter-over-quarter basis, and the pound-dollar currency pair. Now, I don't know exactly how they're measuring it, but it was reported on Bloomberg that this was, I think, the best number in about 5 years. Now, my chart's a little bit different. Maybe it's the scale that we're talking about. But nevertheless, you can see that huge spike to the upside. We were talking about a double-dip recession, or a double-dip, I don't know if it's technically a recession, but we were in negative territory. We had negative GDP for the second time in the UK. Maybe it was a result of the Olympics. I can't think of anything else. There is a massive stimulus program that is currently underway in the UK in the form of, it's their own quantitative easing. It's an asset purchase program that's actually very, very large. Maybe that's helping. So GDP in other countries is progressing. In fact, I have a really cool chart. This is the GDP. I really wish these charts were a little bit larger, but actually I can make it larger. Right. Oh, we have to increase it this way. All right. Take a look at, these are the different GDP figures from the 8 different currencies that we follow. The black dotted line, by the way, is the moving average. The orange line is the UK GDP yesterday. The white line is the US GDP, the last result of 1.3%. Ironically, it's, now, again, these are my unscientific charts, so maybe I'm making a mistake with the scale. But ironically, the US GDP is actually at the upper end of the range. So it's not necessarily, and I wouldn't put too much credence in the actual level, the 1.3%. The reason being is because the UK GDP is really only released every quarter. The US GDP is updated. It's a quarterly number, but we have new estimates every month. But what's really interesting is the direction. They say the trend is your friend. And then take a look at the direction of the line. The white line, the US GDP number, the white line has been moving lower. We hit a high of, 3% GDP, March of this year, and we've continued to go lower, lower, lower. The UK GDP, again, we had a double bottom pattern, but we're moving to the upside. New Zealand GDP selling off, so is Swiss GDP. Everything else is holding steady. And it actually looks like the gross domestic product number in Canada is the strongest on a relative basis. And the reason why this is important to us as Forex traders is very simply because we want to try to align ourselves with the currency pair that has the best potential to establish a nice strong trend. 8:15, so we have 15 minutes ago. And based on this chart, well, I think that, we saw a huge move to the upside in the pound currency. Let's go to the pound currency, actually. The pound dollar, we saw a huge move to the upside as a result of the GDP number yesterday. That explains that big green candlestick yesterday. And we say, well, if the trend is your friend and the trend is moving to the upside in the pound and the trend is moving to the downside in the U.S., would it not make sense that the pound dollar should go up? Now, overlay that with our chart on the right-hand side, the pound dollar, over the short term, past 2 days has gone up, but a little bit longer time frame, this is a daily chart here, we can see that the pound dollar has already gone up quite a bit, and in fact, it looks like we're moving to the downside. So how do you explain this contradiction? Oh, it could be a case of buying the rumor, selling the news. Or very simply, just could be a case if there's more that we have to take into consideration. Now, it gets really complicated because we have a quantitative easing 3 program in the U.S., and we have a massive asset purchase program, a bond buyback program in the U.K. as well. So we take all that into consideration. So there's not a real clear-cut, easy, fundamental way to say, okay, I think that the pound dollar is a good buy or a good sell. That's tough. But on a day-to-day basis, I think we can use these numbers to find the trade based on the expectations. Speaking of expectations, by the way, this is from the FOMC website. Now, they put out projections. The Federal Reserve puts out projections where they believe GDP should fall. As of the June projection, we're looking up here. As of June, the expectation was U.S. GDP would fall between 1.9 and 2.4%. This statement, and we're going to get refreshed, new data, but the Federal Reserve has to release the minutes from the meeting. The meeting was just yesterday, so we need some time for that to take place. But this is based on the September 13th Federal Reserve meeting. This is when QE3 was announced. And that's a nice, I like to use the starting dates of when a massive program like QE3 was announced, because that gives us a benchmark to say, okay, well, as of September 13th, this is where we stood. This is where the economy was, and this is what the Federal Reserve believed, that we should be. Okay. So in June, the Federal Reserve they projected 1.9 to 2.4% GDP. On September 13th, the day that QE3 was announced, GDP projections were revised down to 1.7 to 2.0%. Again, what are our expectations for today? U.S. GDP today is projected to fall 1.9%. So let's say we come in line, or let's say even a little bit better, 1.9%, 2.0, 2.1. What does that mean as far as the dollar, QE3, and our trades are concerned? Well, I think that if U.S. GDP comes in line or better than expectations, if it happens to be really good news today, then the Federal Reserve, and I don't think it's going to be immediate, I don't think that it would be enough for the Fed to have an emergency meeting and to all of a sudden start to make massive changes. Federal Reserve, central banks are very slow-moving vehicles. It's just they sit back, they watch a lot of economic numbers, but all these economic numbers we put together to create a trend. But let's say again that the number is really, really good today, at least in line with expectation, 1.9% or better. The Federal Reserve, I think, is going to say, okay, well, this is some real sign of improvement. I mean, that 1.3% GDP, that was really hurting us. That was hurting our credibility for a long time. And that, we've told the world that we're not going to raise interest rates until 2014. No, I'm sorry, now 2015. And that we said QE3 is basically QE3 perpetual. That it's never going to, it will only end when things get a lot better. Now we can be a little bit more, specific. We can say, well, U.S. GDP is better. We have to wait for employment to improve, but this is a really good sign. And I think you're going to start to see a very little bit of an expectation that QE3 may end. I don't think it'll end so soon as December. Operation Twist, by the way, is supposed to end in December. The difference between the two is that Operation Twist, we don't print new money. They sell short-term bonds to buy long-term bonds. QE3 to printing new money to buy long-term bonds. Operation Twist, just to give you a little background, it was supposed to end in June, but it was extended through December. And as of yesterday's meeting, it will still expire in December. So, with that said, I think if the number is good, in line with expectations or better, Operation Twist, they'll say, okay, we're going to let this thing expire in December, and maybe quantitative easing 3, maybe that'll be extended. For some reason, the Fed seems to like the month of June, to end programs. QE2 ended in June of 2011. But as that expectation, gets closer and closer, I think you're going to see, let's go back to the chart, the dollar chart, I think you're going to see a stronger dollar. The dollar goes up in expectations of higher interest rates. The dollar goes down if we expect lower interest rates. The dollar will also go down under quantitative easing because during quantitative easing, again, we print new money to buy long-term treasury bonds or to buy mortgage-backed securities, but the activity of printing new money dilutes the dollar and sends the dollar lower. We all know this. So I think if the number is good, that will translate to a stronger dollar, and I think that's a trend that we haven't seen this kind of straightforward, logical correlation for a long time. Good U.S. number, dollar goes up. Bad U.S. number, dollar goes down. I think that over time, as the economy starts to improve, you're going to see that correlation come back. If the number is bad, well, then again, I think if the number is bad, I think you could see the same correlation. I mean, we're just guessing at this point because we don't know what the number will be. But if the number is bad, traders are going to say, well, Operation Twist, that'll probably still end in December unless things get really, really bad. But QE3 is basically QE3 perpetual. That the Federal Reserve, in fact, we don't have to guess. This is the statement from yesterday. The last paragraph. To support continued progress towards maximum employment price stability, the committee expects a highly accommodative stance in monetary policy will remain appropriate for a considerable time after the economic recovery strengthens. In particular, the committee also decided to keep the target rate for Fed funds at the 0.25% level. That's through 2015. But I wanted to talk about the actual program. To support a stronger economic recovery and to help ensure inflation over time is at the rate most consistent with its dual mandate, the committee will continue to purchase additional agency mortgage-backed securities at a pace of $40 billion a month. And they also talk about this is the actual talk where they discuss QE3 Operation Twist. But I know I'm probably repeating myself, but it's really kind of interesting stuff. This is the difference. They say, okay, these actions together will increase the committee's holdings of longer-term securities by about $85 billion each month through the end of the year. Remember QE2? QE2 was really very, very strong. Made the stock market go up a lot, really sent up commodity prices. The reason why gold went up so much, a very large part of that gold rally was QE2. QE2, if I'm not mistaken, purchased $75 billion a month of long-term treasuries. Treasuries. I probably spelled that wrong. Sorry. Okay. Operation Twist. Okay, so we currently have $85 billion a month of long-term securities. But wait, if you just look at that and say, well, we're actually doing more now, but we're not. Because Operation Twist, which is about $40 billion a month, will end in December. And remember, Operation Twist does not print money, but rather sells short-term to buy long-term securities. Okay. So take that away from the $85 billion. What do we have left? We have another $45 billion. I could be off by about $5 billion. But there's another $40 billion, which is actually Q3. And they're buying mortgage-backed securities, MBS, mortgage-backed securities. So compare QE3 to QE2. QE3, I don't think is going to have the same kind of effect that we saw on QE2, meaning I don't think gold is going to go up as much. I don't think the dollar is going to go down as much. I don't necessarily think that the stock market's going to go up as much either as we did in QE2. Because we're simply printing less money, about half as much. And I don't know necessarily that it's going to have this broad-based effect the way QE2 did to the overall economy, that a lot of stock prices went up, and we really saw a lot of inflation occur everywhere because it's not buying long-term treasuries or buying mortgage-backed securities. So I think it will have a direct impact on the housing market. I think that the greatest amount of inflation that we'll see moving forward will be in housing. Now, we have to talk about which region and home prices versus rental prices. I think that rental prices will really see a lot of inflation. I think those will go up a lot faster than home prices will. But it's interesting to see how they've designed this program. It seems that the Fed, and this is just my perception, but it seems the Federal Reserve is just so unbelievably sensitive to political pressure these days. I don't like it. Because in the past, with QE1, QE2, and the price of oil went up to $150 a barrel, and or $100 a barrel, and unbelievable inflation in commodities, which is really not good if we can't afford it. So everybody screamed at the Federal Reserve, no more QE2. QE2 is making life too expensive for us. And then the other side, and then they took QE2 off the table. Remember June of last year? And then all of a sudden, this is what happened. Daily chart. Sorry, a lot of lines here. But this is what happened June of 2011. This huge 2,000-point move in about 2 weeks. Why did the stock market crash in June of last year? This was the end of QE2. They take their foot off the gas pedal, and this is what happens. The stock market goes down. So, there's a lot of people, a lot of congressmen. They're telling the Federal Reserve more QE, but don't give us QE that's going to result in so much inflation. You almost have to feel bad for the Federal Reserve. What can they possibly do? Well, this is their best solution so far. They have a mixture of Operation Twist. So they're selling short-term bonds to buy long-term bonds, which means it will not result in the kind of inflation, but hopefully it will help the housing markets. And then they embarked on QE3, which I call Diet QE3 because it's about half the size of QE2. And it's not even buying long-term treasuries. It's specifically targeting the housing markets. I happen to think that all of this is not the best solution. I think the best solution is in fiscal policy. Got to take away the regulations that are preventing growth in the housing market. But that's another discussion. We have about 30 seconds to go here. Again, U.S. GDP expected at 1.9%. If you get the number before we do, please feel free to chat it in. We're watching the dollar-Swiss currency pair. Is that right? 2.0? I believe you, but I have to see it for my own eyes. I believe it. I believe you anyway. 2.0%. Well, that is really something. We're expecting 1.3%. Last month's estimate was 1.3%. We were expecting 1.9%. It's actually 2.0. Watch the dollar Swiss very closely. In fact, we're going to watch a couple different things here. Okay, so top left-hand corner, dollar Swissy. Bottom left-hand corner, these are all 5-minute charts. Now, what did I say? If the number's good, maybe that means we're going to see a stronger dollar. And I think if the dollar goes up, I think gold goes down. So dollar's at the top, gold's at the bottom. And my guess was that we'll see a stronger dollar and a weaker gold. I hope the market doesn't make me look stupid. Dow Jones Industrial Average, that's a tough call. If we think that there's no more QE3, oh, and by the way, as far as the trade's concerned, aside from that, I might look at like an Aussie yen. I think the most logical move would be a move into higher yielding currencies and out of lower yielding currencies. So I think the Aussie yen, Kiwi yen could go up. I think the yen cross will go up. Dollar yen, by the way, has been very strong lately. The tough call is the Dow Jones Industrial Average. My instinct tells me I think stocks will go down. Because if this really is good news and it really means that we're a little bit closer to quantitative easing ending, then all the traders are saying, well, I remember what happened last June of 2011, when all of a sudden QE2 ended and the stock market went down, the Dow went down 2,000 points. So logically, I'd expect the dollar to go up, gold to go down, the stock market, I don't know. And the Aussie yen crosses, logically, I think those could really go up. The dollar yen, can I squeeze one more here? The dollar yen, I really would expect a lot of strength from as well. I think that, if I'm not mistaken, did it already happen? We're expecting a big Bank of Japan meeting. We had CPI last night. Bank of Japan, no, it didn't happen yet. Of course not. No, it's next week. Next week, a big event is the Bank of Japan, where they've announced, where they already have this massive quantitative easing of their own. And I heard something on Bloomberg about the fact that there are many traders expecting, or the broad-based consensus, I guess, is that they will expand their quantitative easing program, and that is one of the reasons why the dollar yen has been so strong lately. So keep an eye out for that. That's next week, Bank of Japan. So logically, I think the dollar yen, it's actually been, the dollar yen is a currency pair I normally ignore because it's really, really tough and it's always range bound. It doesn't really do anything. And I really wasn't paying attention. Look to see what happened to the dollar yen over the past 2 weeks. That's a very, very big move for the dollar yen. Also breaking the downtrending channel. The next very big level, by the way, in dollar yen is 80. We're at 79.92. It's actually higher. It's 80.61. That's dollar yen. Okay, so U.S. GDP. Excuse me, where does this put us now? U.S. GDP, 2.0%. It's the strongest, at least according to my calculations, of any of the currencies that we follow. Could lead to a stronger dollar. So what currencies do we short? Well, the yen, I think, is one. I think the dollar yen is at least according to the current trend, to the upside. By the way, as we speak, take a look at the dollar. Based on this chart, let's just do this, let's just go down the list. Compare GDP to GDP. The dollar versus the CAD, well, not really. Growth is pretty strong in Canada. Yen, that's a logical trade. The dollar against the Kiwi and the Aussie, well, although the growth and the rate of growth in the U.S. technically is stronger than that of Australia and New Zealand, you're going to get a lot of cross currents, because what happens is that if the U.S. economy is improving, if the global economy is improving, that capital is naturally going to go into those higher yielding currencies in order to take more risk. So, ironically, even if growth in the U.S. is faster than it is in Australia, traders are going to go buy the Aussie and go buy the Kiwi to take advantage of the higher yield. We buy higher yield when we think the global economy is improving, especially when we talk about the commodity-based currencies like the Aussie and the Kiwi that benefit from better global growth. So take that off the table. That's the Aussie dollar, Kiwi dollar. That's actually kind of a tough play. Aussie yen, Kiwi yen is a different story. But Aussie dollar, I think we're going to see a strong dollar. So Aussie dollar, Kiwi dollar is tough to say. I would not short the pound, not after their latest GDP figure. Swissy, different story. Swissy, we have declining GDP, probably near the bottom of the list at this point, alongside with the euro. And I would also feel a lot more comfortable, at least according to this chart, selling short the euro, but also because we had the iPhone number this week. And the iPhone number this week was not good at all. That's the German, is it the investor confidence number? I always mix up the iPhone and the zoo. Here's the iPhone. The zoo is a German business confidence number. The IFO is a business climate index. IFO dropped to 100. This was a couple days ago. These are the lowest levels we've seen since July of 2010. So you take a look at, at least according to these numbers, and again, one number does not create a trend. But we talked about the UK GDP, which has really, on Bloomberg, again, I read it was the best improvement in 5 years. US GDP, we're not out of the woods with 2%, but it's definitely a move in the right direction. But the iPhone number, we don't want to see this continue to decline, especially a number coming out of Germany. Take a look at our current situation as well. It's basically a poll that asks, I forget if it's investors or if it's the equivalent of Fortune 500 companies. It's a very timely figure, though, the iPhone. The current situation asks, what do you think? In Germany, what do you think about the economy right now? That number, at one point, we were at 123 in July of last year. We're now at 107. The business climate index at one point was up at the 114 level, now at 100. Gold is going up and the dollar is going down. Very, very curious. And the stock market's going up. This is very curious because I would normally expect the dollar to go up if, this number alludes to the fact that and the economy is getting better. But there's a lot in the GDP number, so that's what we're not seeing. Okay, so going back to that previous chart, we see the situation getting a little bit better in the U.S. and the U.K., and I think that that leads us logically to, I'm looking for my chart here, that leads us logically to something like the dollar Swissy. Look for a currency pair where the interest rates are very close together. The U.S. is at 0, Swiss National Bank is at 0, Eurozone 0.75%, that's very close. I think that's one of the reasons why we've seen such strong moves in the euro dollar and dollar Swissy lately. And barring any unforeseen conditions, I think that could continue. Meaning euro dollar down, dollar Swissy up. Dollar Swissy daily chart. It feels like, just by watching the market, it feels like these moves have been stronger. Maybe I've just been watching 5-minute charts too often, but over the past couple of days, we've seen a lot of strength in the dollar Swissy. I thought it had made more progress than that. We've also seen a lot of weakness in the euro dollar, but overall you can see that Swiss yen rates almost, it's basically, as well. So look for those currency pairs, by the way, I'm trying to complete my thought, sorry, is that look for a currency pair where two currencies have very similar interest rates, but yet their conditions are not the same, or they're separating. Meaning that, okay, dollar Swissy. Interest rates in the dollar and the Swissy are both basically 0. But the conditions in the U.S. are improving at a much, at least according to the GDP data, are getting a lot better than they are in Switzerland. U.S. GDP is at 2%. Swiss GDP, the latest result is a negative 0.1%. It's not a completely fair comparison, apples to apples, because there's different ways that they measure their economies. And we're just talking about GDP. We should really, to do a thorough job, we have to really compare the currencies against, each other through all the major economic numbers. Here's inflation, CPI, Consumer Price Index. Trying to get this chart sized just right so you can see it. All right. So, CPI at the top of the list, Eurozone. That followed by the pound, the dollar, the Aussie, and then the CAD. All above their overall G8 average. Who stands at the bottom of the list? New Zealand, Japan, Switzerland. So take away New Zealand because they have much higher interest rates in the U.S. So you compare the U.S. dollar to the Japanese yen. Both have near 0 interest rates. Aussie and Kiwi have very similar interest rates, but remember, we're looking for two currencies where the conditions are massively diverging. Australia and New Zealand, well, the CPI does show that Aussie is faring much better than New Zealand in terms of inflation. But their growth rates, or GDP numbers, are almost identical. And the fact of the matter is those economies are so closely linked. They're both export-driven economies, and they're both so very sensitive to the rate of global growth around the globe, and the consumption of commodities, and to China. I would not expect a lot of divergence from Aussie Kiwi. Dollar versus yen, those are two very, very different economies. Dollar versus Switzerland, two very different economies, or the U.S. versus Switzerland. Australia versus New Zealand, they're very, very similar, relatively speaking. Because the easiest way to look at this is to consider the fact that, this takes us back to Forex 101. There are two types of economies that we follow. We have an export-driven economy and a capital investment, capital-intensive type of economy. Japan, Australia, New Zealand, Switzerland, Germany, Canada to some extent, those are export-driven economies. Those are economies where if the currency goes down, it's actually a good thing. Japan likes when the currency goes down because they derive most of their GDP from exports. And when the Japanese yen gets weaker, it means their exports get less expensive for the consumers from the rest of the world, and then more of us can buy more of their goods. So that's why the Bank of Japan has almost a continuous near zero interest rate policy. They want to weak Japanese yen. They love when the dollar yen and the euro yen go up because it means the rest of us can buy more goods and services from Japan. Switzerland exports financial services, same situation. That's why the Swiss National Bank has embarked on this massive, intervention that I think has probably never been done before, that they said, well, we're not going to let the euro Swissy fall below 120. Enough is enough. That's 120. This is what the chart looks like. This was the euro Swissy before. Once upon a time, this currency pair used to move. I think the only way this currency pair moves is up. I don't know if it's going to move anywhere now. But as Europe improves, it could go up. But it's not going below 120 because the Swiss National Bank says we're stopping it at 120. We're going to hold the market there. So Switzerland, export-driven economy. Europe's difficult because Germany is an export-driven economy versus other countries in Europe which are not so directly tied to exports. The U.S., other side of the coin. The U.S. and many parts of Europe are a capital investment type of economy. I'd say the U.K. also is classified under that area as well because the U.S. economy benefits from foreign investment. So it's not that a strong dollar is good for the U.S., but a strong dollar is a symptom. A strong dollar occurs when the U.S. economy is recovering because a strong dollar occurs when the U.S. economy looks better, foreign capital comes into the U.S., to buy U.S. stocks, U.S. real estate, U.S. businesses, U.S. everything. And all of that foreign capital that's, Japanese yen are converted to dollars, euros are converted to dollars, and the dollar ends up going up. So when you see the dollar going up, it doesn't mean it's good for the U.S. It means that something good is already happening in the U.S. So a strong dollar is a sign that things are getting better. That's why we would expect the dollar Swissy to go up if the GDP is going up. I'm kind of curious why it's not happening. Maybe we're looking at a case of buying a rumor, selling the news. I know we only have a few moments left here. But, okay, so we looked at CPI. We looked at GDP. Look at unemployment. This is very subjective, by the way. There's a lot of different ways we can calculate the differences, in the way these numbers are calculated from one country to another. Eurozone unemployment, nevertheless, is at the top of the list. U.S. unemployment was number 2 for a long time. Now it looks like it's tied with the U.K., also for number 2. And then Canada below that, all above the G8 average. The countries, and New Zealand, I guess, is a little bit above as well. The countries with unemployment rates below the average, which show strength: Switzerland, Japan, Australia. It's ironic that the unemployment level seems to be the best in Switzerland and Japan, yet consumer prices seem to be the worst in Switzerland and Japan. And GDP seems to be close to the worst in Switzerland and Japan. How can we explain that the unemployment rates is the best, yet their economies, from all other points of view, CPI and GDP seem not to be so good? I don't know. Maybe it's just the way the economies are structured, that our economies maybe can tolerate a higher rate of unemployment and still, chug along. It's not an apples to apples comparison because, you have different, safety measures, you have different social measures as well. We could say, well, the U.S. needs 5% unemployment in order to match up with a 3% GDP. And that if unemployment goes above 5%, of course we're above 5% for a long time now, that means that we need GDP to be here. It's a difficult thing to compare the two. That's why I kind of like to look at the rate of change, but not just the hard numbers. But getting back to today's number, with the Fed meeting yesterday, the Fed basically said a lot of nothing. They said energy prices are high, unemployment is high, we're looking for some real progress. Well, today we got some real progress. U.S. GDP last month, 1.3% estimate. We're expected to come in 1.9. It was actually 2.0, so beating expectations at the high end of the Federal Reserve's projections. Will the Federal Reserve, when they release the minutes from this past meeting, yesterday's meeting, will they revise up their projections? How optimistic will the Federal Reserve become? That's going to be a real interesting thing to see. And also, of course, watch the economic calendar very closely. In the next couple of days, we have a couple of really big numbers, including personal consumption expenditure, which is used by the Fed in their projections. Eurozone CPI, well, that's in Spain, I believe. We have a Bank of Japan meeting next week as well. And a lot of other good stuff. Oh, Canadian GDP. A lot of other great stuff. 2.0 is going to help the president. I don't know. I think politicians, whatever politicians we have, they'll find a positive way to spend anything. I don't know. I'm sure everybody will find a way to spin it in their favor. But in terms of the economy, it is at least a sign of an improvement. With that said, I'm out of time. If you want to contact me, you can do so directly, www.forexchallenge.com. I want to thank you all very much for joining us. Very special thanks to FX Street. Please see the calendar because we have a lot more to talk about. Again, we thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside FX Street.